Well, even with the recent rebound, one of our traders is sounding the alarm over foreign investors looking to...
After the big tariff announcement, something happened that shocked economists, and it wasn't the stock market dropping. It was the value of the dollar dropping. Usually in times of market turmoil, it increases because investors are flocking to the U.S. for safety.
We saw exactly the opposite. Money fled from the U.S. for safety instead of to the U.S. for safety for the first time in my memory.
That was a sign that something was getting different and that people weren't just shifting between U.S. assets. They were getting nervous about U.S. assets.
Before we start, I want to let everyone know that this is strictly my opinion. All conclusions are based on my analysis of the global situation. Support my friend with a subscription and a like. The countdown is on August 3, 2025, is here, and a financial crisis looms as the U.S. faces a dire warning. At 5:30 a.m., says Today, reports signal that $38 trillion in global wealth, nearly double the U.S. GDP, could evaporate overnight. This isn't a thriller script, it's the chilling forecast from JPMorgan Chase, rattling markets worldwide. Investors are asking, are we teetering on the brink of the greatest economic meltdown ever? Today, we'll uncover what this $38 trillion danger means, where it's brewing, and how it might hit your savings sooner than you expect. Hold tight, this could redefine everything. Over the past month, markets have trembled as investment flows falter. But JPMorgan's latest analysis has escalated the panic. Up to $38 trillion in global assets is at risk of a sudden plunge, driven by a volatile mix of economic and geopolitical forces colliding at breakneck speed. The core issue is a dramatic shift in capital, with funds fleeing U.S. investments for emerging markets, precious metals, and new shelters. Traditionally, the U.S. dollar and government bonds were the go-to refuge. Yet, mounting U.S. debt, spiking interest rates, and global unrest are shaking that trust. When major investors, hedge funds, sovereign wealth funds start pulling out, the fallout can be catastrophic. JPMorgan cautions that a swift dump of U.S. bonds, stocks, or currency could spark a domino crash across equity markets, retirement funds, and banks. This wouldn't just sting Wall Street, it'd hit your daily life. Pensions could shrink, loan rates could soar, and the dollar's value might plummet. Adding fuel to the fire is the rising trend of de-dollarization. More nations are trading beyond the U.S. dollar framework, straining America's financial grip. If countries collectively ditch U.S. debt, markets could face a liquidity crisis dwarfing 2008, but on a global scale. While JPMorgan stops short of predicting doom, their alert screams, the economy balances on a knife's edge. A panic could turn this $38 trillion risk into reality in days. The $38 trillion threat JPMorgan flags isn't just a headline, it's rooted in real economic cracks that could shatter fast. Let's dissect it. First, U.S. national debt is a ticking bomb, surpassing $36 trillion and outpacing annual economic output. Investors once trusted the dollar as a safe haven, but with the Federal Reserve hiking rates to curb inflation, debt servicing costs are ballooning. If big buyers like China or Europe start offloading U.S. bonds, prices could crash, borrowing costs could skyrocket, and markets could quake. Second, de-dollarization gains traction. BRICS nations China, India, Brazil are favoring local currencies or digital platforms for trade. Each move outside the dollar chips away at its dominance, risking a flood of treasury sales that could destabilize trillions. Third, geopolitical strife, trade disputes with China, sanctions on Russia, Middle East tensions keeps investors on edge, driving them to gold, oil, or crypto over traditional assets. Lastly, JPMorgan points to the shadow finance world, hedge funds, private equity, and unregulated lenders holding trillions. A liquidity hit to one could trigger a cascade, echoing 2008, but with global reach. This isn't a doomsday prophecy, but a stark warning of a brittle system where $38 trillion could vanish if confidence cracks. If a $38 trillion market crash sounds distant, the domino effect is brutally real. Here's how it could play out and who'd suffer most. It might start with U.S. bond markets, where trillions in government debt sit. If a major holder, say Japan or Saudi Arabia, dumps treasuries, bond values would drop, yields would jump, and borrowing costs would spike, hitting mortgages, auto loans, and business credit hard. This Washington shock would slam Main Street households. Next, pension funds and retirement accounts, packed with stocks and bonds, could lose billions in a flash sell-off, devastating retirees and future planners. A 10 to 15% market dip isn't just a trader's headache, it erases years of savings. Then, U.S. banks and shadow lenders, loaded with risky debts and derivatives, could face margin calls and asset liquidations. Freezing credit like 2008, with global exposure doubled since then. The spread could be worse. Overseas, BRICS nations, despite diversifying, still hold U.S. assets. Panic could trigger capital flight from emerging markets, crashing their currencies as investors flee to safety. This could spike volatility in gold or crypto, ironically destabilizing those havens. Everyday people would feel it: job cuts as firms tighten belts, rising costs from currency shifts, even bank limits if cash runs dry. History proves confidence breaks fast in global finance, and JPMorgan's report warns this $38 trillion loss could ripple to every paycheck and savings account worldwide. A $38 trillion meltdown sounds scary, but can it be stopped? JPMorgan's report and top economists suggest possible defenses, though success isn't certain. The Federal Reserve could lead, cutting rates, buying bonds, or lending to banks in a crisis tools that steadied 2008 and 2020, but with inflation still high, the Fed's hands are tied. Slashing rates or pumping money could ignite prices, slowing any quick response. The U.S. Treasury might step in, backing debt or bailing out firms, but with $36 trillion in debt, new rescues could deepen distrust. Globally, the IMF and central banks from Europe or Japan could coordinate liquidity swaps or currency support. Yet, with U.S.-China tensions and fractured alliances, unity is shaky. Some argue prevention is key: cutting U.S. deficits, easing trade conflicts, and forging capital pacts with BRICS. Without this, a panic could outpace fixes. Restoring trust once lost is the real challenge. The 2008 Lehman collapse froze credit in days. A $38 trillion shock could overwhelm even bold rescues. Yes, governments have tools, but in today's fragile world, they might be too late, too weak, or too divisive to halt a sudden crash. A $38 trillion market shock isn't guaranteed, but JPMorgan's warning is a jolt. Decades of debt growth, geopolitical rifts, and shifting investor trust have built a system where a single misstep could ignite chaos. Optimists say markets will adjust. U.S. growth holds, earnings are solid, and banks learned from 2008. They see wealth shifting, not vanishing. Pessimists warn of a debt-laden, liquidity-dependent structure teetering on foreign faith. If that faith fails, families, retirees, and small businesses could see savings vanish, loans dry up, and costs spike. This story's unfolding. The next months will test how the U.S., China, and BRICS navigate currency moves, debt, and tensions. One slip could trigger JPMorgan's dominoes. If you're here, you know we dive deep into stories media skim. This $38 trillion risk could reshape your finances. Stay sharp, stay ready, subscribe, hit notifications, and join us for unfiltered market truth before the news catches up. Friends, support my channel. Give this video a like. It will be a huge motivation for me to post several videos every day. Thank you. Over the past month, markets have trembled as investment flows falter. But JPMorgan's latest analysis has escalated the panic. Up to $38 trillion in global assets is at risk of a sudden plunge, driven by a volatile mix of economic and geopolitical forces colliding at breakneck speed. The core issue is a dramatic shift in capital, with funds fleeing U.S. investments for emerging markets, precious metals, and new shelters. Traditionally, the U.S. dollar and government bonds were the go-to refuge. Yet, mounting U.S. debt, spiking interest rates, and global unrest are shaking that trust. When major investors, hedge funds, sovereign wealth funds start pulling out, the fallout can be catastrophic. JPMorgan cautions that a swift dump of U.S. bonds, stocks, or currency could spark a domino crash across equity markets, retirement funds, and banks. This wouldn't just sting Wall Street, it'd hit your daily life. Pensions could shrink, loan rates could soar, and the dollar's value might plummet. Adding fuel to the fire is the rising trend of de-dollarization.